Good afternoon, ladies and gentlemen, and welcome to the Solid State PLC presentation for the year ended 31st of March 2020. To start with, if we could cover a couple of housekeeping items before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via solidstate@walbrookpr.com. The company may not be in a position to answer every question it receives during the meeting. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via the Investor Meet Company dashboard. Finally, we'd like to remind you that this presentation is being recorded. We anticipate that there'll be some newcomers to Solid State, so we will take a couple of minutes at the beginning of the presentation to introduce the business. So let me now hand you over to Chief Executive Gary Marsh and Group Finance Director Peter James. Gary.
Thank you, Tom. I'd like to welcome you to our first Investor Meet Company presentation. Thank you for taking the time to join us this afternoon. We'd welcome any feedback you may have, so please feel free to do that. We're about to show you a short video on the group. It's 2 minutes, 4 seconds to be precise. But before we do, I'll explain our group structure to put it in some context. Solid State is made up of 2 divisions. Manufacturing, under the directorship of Matthew Richards, focuses on computing, power and communication products, typically for use in harsh environments. And value-added distribution, or VAD as we'll refer to it through the presentation, under John McMichael, which now includes our last acquisition, Pacer, which brought new opto components to the group. There's very little overlap in products between SSS and Pacer, and it hugely increases our value-added capability and has taken us into new markets such as medical, which have long been a target for the group. Solid State PLC is a high value-add manufacturer and specialist design and distributor to the electronics industry. We do the difficult things small companies can't do and the large manufacturers don't want to do.
Solid State PLC has delivered double-digit compound growth organically and through acquisition since it was admitted to AIM in 1996. The group has the operational infrastructure and its centres of excellence to deliver material growth with modest additional investment.
We are increasing our margins through integrating into the value chain. Our enhanced capabilities in value-added distribution and manufacturing provide a comprehensive offering to our customers seeking a design-led solution and gives the group diversification and resilience.
The manufacturing division delivers technology in the computing, power and communication sectors. We deliver products that operate in the harshest environments on land, sea or air, where reliability and safety are critically important.
The distribution business focuses on providing leading-edge products to customers. We provide value-added services and technical support together with wide-ranging commercial solutions.
Our strategy has 3 key elements: to invest in our people to maintain technical knowledge and remain at the forefront of the electronics industry. Secondly, to target strategic acquisitions which are aligned to our core capabilities. And finally, to continue to develop our strategic partnerships with our customers and suppliers. We've built a proven acquisition track record over more than a decade. Through future acquisitions, we will continue to target structural growth markets. We are confident we have the capabilities and the strategy to deliver strong growth over the coming years. We've built a reputation of supplying trusted technology the demanding applications, we focus on 4 key capabilities: computing, power, communications, and electronic distribution. And these aren't generally the core competencies of our customers. Safety, quality, and reliability are paramount to our customers, whether it be rugged computers, rugged computer systems for warship operations, battery packs for robotics, or antenna systems for Met Office weather radar. We have a deep knowledge of our chosen fields, providing impartial, consultative product selection. As a trusted partner, we provide reliable long-term supply with strict revision control. And our distribution division follows the same philosophy, taking the time to solve customers' problems through its technical staff, resulting in higher design-in levels for our suppliers and increasing the value of distribution to our customers. I'll obviously expect me to go through where we are with COVID-19. So the business reacted early, with all staff who could work from home being equipped to do so. The systems tested long before the 23rd March lockdown, together with implementation of hygiene and social distancing measures to keep staff who continue to work from our location safe. Our 4 production facilities have remained open throughout this period. We've adopted new ways of working, including clean desk policies, a policy we'd meant to implement ages ago, but this has brought that forward, so we're pleased with that. That's to ease sanitisation, and these changes have presented opportunities to streamline our systems. With the majority of our staff working remotely, regular, upbeat, honest communication by the directors has been key, whether through videos to staff or video conferencing. We wanted to provide regular market updates to the markets too, as we did so in March, April, and earlier this month. Alongside health, the well-being of our staff has been just as important. Through our group medical cover, we introduced online mental health support. We established new ways to engage with staff, introduced online quiz nights, Friday afternoon clubs, and even walked the length of England, raising £10,000 for NHS charities together, which was covered in the local press. It was a really good day. The board has taken prudent steps to mitigate and manage our cash flow and cost base. These included a recruitment freeze, a salary increase freeze for all directors and staff, adoption of available deferrals for VAT and PAYE payments to HMRC, and furloughing of some of the staff under the coronavirus job retention scheme. We've also negotiated better terms with some suppliers and landlords. Microsoft Teams has been a real godsend. Life would have been very difficult had this pandemic occurred 20 or 30 years ago. In many cases, it's improved productivity, with our sales teams meeting 7 customers in a day via Teams rather than 1 or 2 having driven a couple of hours to meet them face to face. We've found new ways to engage with clients, including virtual hands-on design and specification meetings. Again, with more engineers joining these meetings than they would have done if we'd have held them face to face. Some of these new initiatives that certainly have improved our productivity, I believe, are here to stay. We've used the time to accelerate product development for environmental applications and transportation, where we're likely to see, we believe, some government stimulus packages, and we can take benefit from those. We've delivered another record year of revenue growth, achieving record EPS, now up 50% since 2018. And given our strong cash position, being a cash generative business and following a record year, we've maintained last year's dividend, unlike many. We're continuing to execute on our strategy. Pacer is now integrated with operating margins up more than 3% over the prior year, driven by a combination of operational efficiencies and increased value-added sales. We're going to talk you through our product development, especially in fossil fuel replacement in our power business unit, and steps we've taken to improve group collaboration. Finally, we'll cover areas where we've been investing for the future. I'll hand you over to Pete now, who'll talk you through some of the numbers.
Thanks, Gary. So I'll just start with some of the headlines here. So starting with the top line and revenue, pleasingly reported revenues up 20%, and pro forma revenue, so like-for-like revenue, including a full year of Pacer, is up 4.3%, reflecting organic growth. Coming down from there, margins have improved in spite of the growth in our value-added distribution division, which might potentially be dilutive, which reflects strengthening margins in both divisions. The full year of Pacer has helped improve and increase the margins there, where we've got a greater proportion of higher value-added business through that division. And the organic growth in manufacturing has bolstered margins there, up to the high 30s this year, from the mid 30s last year as the manufacturing division. Down to the operating margin level, which is really the key metric for the group. And you can see their adjusted operating margin is up 70 basis points to 7.2%, which is very pleasing. And that reflects the combination of the top line growth, leveraging the operational gearing, as well as some of the productivity and efficiencies we've managed to access through integrating Pacer into the value-added distribution division. That translates into record EPS for the group at 46.3p, which is up close to 30%. And as Gary said just a moment ago, that's given the board the confidence to maintain the dividend in spite of the challenges presented of COVID-19. So if we move on towards the cash flow, cash this year, operating cash of 8 million is very positive. If you look in the announcement, that has benefited from some pretty significant working capital inflows. Gary talked about the steps we took in our Q4 to conserve cash, and that resulted in a working capital inflow of about 1.4 million. Even if you exclude that, the cash conversion is still in excess of 125%, so very, very pleasing. The cash activities we took in terms of COVID-19 were utilising the government deferments on PAYE, VAT, job retention scheme. But particularly pleasing was the work we did with our supply chain to get better terms with our Asian suppliers. We did see lead times extend. We did place orders and build buffer stock to manage that. And in doing that, we worked with our suppliers to get better terms, which they were supportive in doing, which has been fantastic. Coming down, the 500,000 cash flow and payment obligations for right of use assets, that's as a result of the adoption of IFRS 16 this year, where our leases get brought on balance sheet. So when we turn over leaf, you'll see the impact of that. And CapEx, similar level, broadly comparable level. We've continued to invest in CapEx, and that's been particularly in our Weymouth facility, where we do our value-added distribution, that was brought into the group with the Pacer acquisition. We've invested in some tooling there to give us better productivity and operational efficiencies, and that's helped deliver that operating margin improvement for that division. And finally, what does that turn into? That means we've translated our net debt of 2 million that we took on as a result of the acquisition of Pacer has now returned to net cash at just over 3 million, 3.2 million by the year end. Moving on to the balance sheet, IFRS 16, as I said, has a pretty material impact on grossing up of the balance sheet. So we recognise 1.1 million of lease obligations and 1.1 million of lease liabilities. So the net asset impact is immaterial, but the gross assets and gross liabilities are increased. Probably more pertinent is the buffer stock. Year on year, stock is pretty stable. last year we built some buffer stock to ready the supply chain for the ill-fated Brexit that never really happened, and that was backed by customer demand through Q4, or the Q4 that had just gone in 18-19. In 2019-20, the current year, we did put buffer stock in to ready the business for what was going to be a challenge potentially with COVID-19, and that buffer stock has been really important in enabling us to deliver well in Q1, which we were pleased to be able to announce earlier this morning. Net cash, 3.2 million, and we've still got an RCF available that's now committed out to November 2021. It puts the business in a very good position to invest as we come out of the COVID-19 and hopefully exploit some opportunities on the M&A front that may well come to pass as we come towards the end of government support. This slide's got probably the most arrogant slide. We're winning because there's two real key pillars to our strategy. The best-in-class people, we absolutely continue to invest in our people. In the current year, we've really invested in technical resource and business development resource, and that really has enabled us to penetrate the market and improve our offering to our customers. Technology is obviously the complement to having those great people. They need great technology on which they can provide to customers. On the value-added distribution side, our franchises continue to innovate. We remain at the leading edge in terms of technology, so 5G solutions. We've also got some new products around LoRaWAN networks, which is almost the exact opposite of 5G. They're low bandwidth radio wide area networks, and it's about simple networks that tell people I'm still here, day-to-day checks. And those products innovations are really important to the breadth of customers we can service. Both divisions are really looking at the opportunities for AI and those applications. Some examples of that might be in the computing team in manufacturing, looking at computing platforms for autonomous quarry trucks. And on the distribution side, we're working with customers on intelligent ultrasound. So the computing platform behind the ultrasound system auto-identifies what it's seeing. So those are quite important. The structure of the group, the combination of value-added distribution and manufacturing gives us a combination of resilience, diversity. We've got a very broad customer base, and the collaborative working now, which Gary will come on to talk to, is really starting to pay dividends and give us an opportunity which we're hoping to harness as we go forward. The Silicon Labs logo there is a highlight of some of the good work we've done more recently. Silicon Labs won a new product line through an acquisition they've done of Red Pine. They've actually decided to give, for UK and Ireland, all of those products to the Solid State Supplies franchise as their UK distributor, and they've done that on an annualized basis. Once we get up to full year run rate, that's probably a couple of $1 million worth of business, and they've done that because we didn't furlough our field sales team, unlike some of our competitors. And pleasingly, we anticipate receiving our first orders, circa 50k, well ahead of expectations in the first half of this financial year. I'll hand back to Gary.
Thanks, Pete. So I'll talk you through our combustion engine replacement program. The drive for electrification in the mainstream automotive sector is evident, and that will continue to gain pace year on year. In line with our strategy, our group strategy, to avoid commoditized markets, we're looking to work with niche sectors that are equally looking to replace fossil fuel powered engines with carbon-free solutions. The drive really is for zero emission vehicles. The sectors include agricultural technology, ground care, light vehicles for construction, railway maintenance, surface and subsea vehicles. We've recognised that a battery alone won't solve the partners' problems. So we've joined up with a specialist electric motor manufacturer, you can see on the top right there, to offer a powertrain solution to our clients. So the box you see, the grey box you see, is the next generation 500 series high density pack. we're developing that will replace the 400 series pack that we already sell in high volumes. So we believe the new design pack will be ideally suited to these applications. Initial interest following direct marketing has been encouraging, even during lockdown. The proposition is not selling, but to offer to solve a problem. New legislation is putting more restrictions on the use of diesel engines in particular. So we're finding companies are receptive to ideas to replace diesel with an electric solution. Petrol has some disadvantages relating to storage, as you could imagine. A business development team are now proactively defining market sectors and then identifying prospective partner companies. We've made good progress with a kick-off project already now underway, and other target companies have been contacted. Our prospective customers can focus on their solution, not worry about the powertrain. This follows the same sort of philosophy in our computer business, with our computing customers focusing on their applications, letting solid state worry about the hardware challenge.
So thanks, Gary. So this slide is an illustration of an example of one of the real strategic objectives that we've identified, that cross collaboration is a really key part of how we're going to grow and succeed as a group. The image on the left hand side is the legacy computer platform that you see on trackside horse race betting booths, and the initial relationship there was a Pacer relationship where we were looking to upgrade the display to a high brightness display to help the guys on the trackside not have to power under the hoods on bright sunny days to see their screens. We then realised pretty soon after that there was a need for a processor and an upsell in terms of a module on that, which the team at Pacer did. And more recently, we now have an opportunity to bid on a manufactured system in a ruggedized case, and that's been passed over to the steer-type computing team, which really plays to their expertise of harsh environment computing platforms. So rather than just providing a display with a processor on the back, we're now looking at bidding on an integrated solution in a ruggedized case that will really address their needs as they upgrade their systems. And I think the thing that this really is pleasing about is it shows the cultural change. I think if you looked back 5, 6, 7 years ago, solid state was very siloed. You had the distribution division on the left and the manufacturing on the right, and there was not a great deal of collaboration and cross-fertilization of opportunities. Since Matthew and John have been leading the business and the strategy review was done, it was very clear that the better together, better, 1 + 1 is 3 type mentality was going to really help drive organic growth for the group, and getting more from the broad customer base of distribution was a key objective. The Pacer acquisition really facilitated that, because the Pacer team really saw the opportunity of joining a bigger group. They were an entrepreneurial bunch, and they've been really open-minded to that and not had any of the history of the silos. So actually, the Pacer acquisition, one thing it brought that I didn't expect was to really see that collaboration accelerate with that team being integrated into the value-added distribution. It really helped the cross-working and the collaboration between both divisions.
And just to give you an idea on that previous slide, we took that from being a £250 display to a £4,000 system. So that's sort of great upselling to existing customers. So moving to the resilience and diversity. Our business model has demonstrated some resilience in this pandemic, established almost 50 years ago now. We're proud of our track record, having paid a dividend every year since we joined AIM in 1996. Our business has consistently been cash generative with low capex needs right across the group. And our organic growth is driven by servicing high growth sectors in IoT, autonomy, security and defence, and transport and medical. And whilst governments are understandably focused on COVID-19, risks haven't gone away in defence and security, and we're well placed to benefit from any increased expenditure in these markets. We recently won a defence programme from the UK government, as they're requiring now 30% of spend to be placed with SMEs. Our wide customer base gives us resilience. We've got no single customer accounting for more than 10% of group sales, and that's been the case for a number of years now. Certainly during lockdown, it's been invaluable having production close to home, operating in the same jurisdiction. And a wide product range, which requires technical support, often with long product lead times, affords us some protection, as customers typically need to place scheduled orders. We're conscious of dilution and eroding shareholder value, and we've delivered strong EPS growth.
Okay. Moving on to the future and where we're looking to invest. Yeah, Gary did allude to the fact initially we paused our CapEx program. As we come out of COVID-19, we will look to reinstate that CapEx program, and there's a number of key capabilities there. So on the test side of things, we're looking at our EMC chamber and RF testing suite. That will enable us to bring in-house our testing capabilities for EMC, and that will reduce our reliance on third-party test houses. That will afford us better flexibility and make us better able to service our customer needs very rapidly. In terms of productivity, we've invested in wire bonders, bulk cure equipment, particularly down in Weymouth, which is the picture you can see on the bottom of that slide. That's our facility in Weymouth, and that enables rapid setting of epoxies, and that gives us better reliability, better quality, and better productivity. And that's a cornerstone of improving those operating margins. So we've continued to invest in systems upgrades, ERP systems upgrades, and looking forward on the new battery pack programs that Gary's talked about. We'll be looking at investing in a welding, an automated or semi-automated welding tool to improve productivity and reliability there as well. Those investments will absolutely underpin quality and will enable us to deliver the products that our customers want and need. We come on to M&A. We will look to resume the M&A program as we come out of COVID-19. We'll continue to be opportunistic at the right time. We're in a pretty strong position with a debt-free balance sheet, in fact, net cash that's continuing to grow, and a strong facility with Lloyds Bank that's committed out to 2021. I think my personal view is, in the near term, while government support is still here, businesses will probably not look. M&A will probably be something that becomes a feature for businesses when that government support is taken away or reduced. So Q3 for us is likely to be the sort of time where businesses think, crikey, being part of a bigger group might be an attractive option. So I think, potentially there might be some opportunities for bolt-on acquisitions that complement the group, good businesses that are just struggling after that government support's gone, where we can integrate them and really be better together. So I think Q3, Q4, towards the end of our financial year is when the M&A program hopefully will start to pick back up. Before I'll hand over to Gary to sum up.
Thanks, Pete. A large customer base and a wide sector coverage and strong debt-free balance sheet gives us some resilience in what are definitely uncertain times. We consider Q2 may be the most unpredictable period as we begin emerging from lockdown. The business has traded well in Q1 as we announced our trading updates, and we've actually traded ahead of expectations in the first 2 months of this fiscal year. But we have seen soft order intake in Q1 down just under 15% compared to the same period last year, and that's come particularly from our smaller customers. Our larger customers have been really quite stable during this period. However, we entered Q2 with a strong open order book of about £40 million, and we're well placed to emerge from this pandemic in a far stronger position, certainly than many of our unlisted competitors. One impact of COVID-19 we feel may well be a shift in global supply chains. Our sales teams are already reporting comments from our OEM customers about buying vital components close to home, and we stand to benefit from that shift. The drive to achieve further cross-group collaboration will continue. That forms part of our group strategy implementation over the coming years, with a focus remaining on supplying trusted technology for demanding applications as we strive to achieve our 5-year goal of doubling the size of the business by 2022. We believe post-COVID-19 we're well placed to achieve our. Thank you all.
Super. Thank you, Gary. Thank you, Pete. Now, if we could turn to the questions. We've had a number of questions that were submitted ahead of the presentation, and questions have been coming in through the course. In fact, some of which have been answered in the progress of the presentation itself. But please do continue to submit your questions with the Q&A tab, and we'll come on to those. Just in the meantime, if I could remind you that this presentation is recorded and it will be posted along with a copy of the slides and the published Q&A on the investor dashboard of the Investor Meet Company platform. So you'll always be able to go back to it, or equally, if you know of people who've not been able to attend, they'll be able to come back and view it post the event. Equally, as Gary previously mentioned, your feedback is very important. So afterwards, when we finish the presentation, if you could fill out the feedback form, that'd be very helpful. What we may do is group a couple of these questions together. And one of the more recent points made there was in respect of comments from clients that had suggested they were reviewing their supply chain. One question here is a question as to whether Solid State has changed its supply chain in response to the pandemic. Gary, maybe you can just pick up on that.
Yeah. We've actually spent a considerable amount of time developing our supply chain as part of the service we offer to our customers, having a robust supply chain. And we've really been very pleasantly, not surprised, but very, very pleased that our supply chain has stood up well. Obviously, they've had closures, but we buffered those with stock, but they've rebounded quite quickly, and it's been testament to that work on developing the supply chain over many years. So we haven't had cause to change it specifically owing to COVID-19. Obviously, it's constantly under review with our procurement team, but as I say, they've responded very well to this pandemic.
Okay, and one other question which may lead on. Do you anticipate any long-term effects from COVID?
We do. I think the environmental side that we've touched on, I think, will be long term. There will probably be requirements for government stimulus for a number of years, and the remote working has certainly brought up areas we can improve our systems and become a bit more productive. So I think there's certainly 3 key themes that will carry through in the years to come.
Okay, super. Now we've got some, just let me run through a couple of these questions here, which we'll pick up as we go through. Two questions. What challenges and changes have you seen in the competitive landscape and pricing, which I'm assuming obviously relates equally to the COVID piece? And the second question, equally, you suggested M&A will be quiet for the next few months. Has this period not shaken loose some competition and bolt-on opportunities that you can leverage sooner? And there are a couple of other acquisition-related questions as well, but we'll come up to those in due course.
Tom, why don't I grab that one to start with, and then Gary can add his perspective after. In terms of competitive landscape and pricing, I think, yeah, the thing that's become increasingly important to our customers is reliability of supply chains, and having put the buffer stock in and demonstrated that we are a reliable supplier and making sure we deliver has become increasingly important. Yeah, yes, price is still important to people, but actually the making sure that they get their product at the right time is a real sort of focus point for them. So I would say, yeah, the competition is there, but it's making sure that we leverage the opportunities that buffer stock has provided us, and we've worked quite hard to do that, and that's been reflected in our Q1 results, where we've been able to maintain a good first quarter, probably better than we anticipated we might have done. In terms of M&A, I think, yeah, the near term, while there's government support, a lot of businesses are not necessarily feeling the full challenge, because you've got furlough job retention scheme, you've got, the CBILS loans, there's various other forms of government support, and it feels a little predatory to be trying to approach businesses right now. I think, when those government support features are being taken away and we're being weaned off them, is when actually some businesses will look to, is there an M&A opportunity that's willing buyer, willing seller to join a bigger group to provide a more stable platform. I think the question there is absolutely valid. We are monitoring a number of opportunities. We've got a pipeline of M&A things that we're looking at and we're keeping close to. But I think, certainly my perspective is that's probably going to be in our second half rather than in our first half.
Super. Gary, do you want anything you want to add to that?
Yeah, we've alerted our sales teams to look at the competition. We've already got a number of companies on as we term it, our watch list, and we continue to actively monitor those. But I agree with Pete. I think the cash issues that will come up haven't fully hit yet, with a number of companies furloughing staff. So that's something we'll work on, and we will approach these companies. I think a lot of it often is timing's important. You don't want, whilst you want to be opportunistic, you don't want to appear too opportunistic. And I think something for the second half for us to focus on as we develop that watch list.
Is it worth me adding, the question above that on the feed is around outstanding cash or stock deferred consideration from recent acquisitions.
Absolutely.
But there is no outstanding debt on those. That debt has been fully repaid. There's no deferred consideration due. So the Pacer acquisition is now fully paid for in all aspects, in terms of we've repaid the bank and there is no deferred consideration.
Yeah, so the viewers can't see that. So the question was, are there any outstanding cash or stock deferred considerations from recent acquisitions? So the answer to that is no. We have a question here on the forward order book. How much of this is committed and under contract? Therefore, how much is potentially at risk for deferral or postponement?
We only take fully committed purchase orders from customers. We obviously have forecast business and business that can shift, but those are all they are scheduled orders from customers. It's not to say they can't be deferred, but we've actually seen some orders being pulled in. We're getting a mixture there. So, for example, in transportation, where the roads have been quieter or the trains have been quieter, people have been doing maintenance programs and actually accelerating those in these early months. But they are all scheduled committed orders, and that's what we've always published in our open order book. And approximately 75% of that is deliverable in this calendar year.
Great. Okay. A question here in relation to into government support schemes. Having taken benefit from the various government schemes in place for COVID-19, what are the future liabilities, and are they addressed by the existing cash balance within the company or within the forecast 2020 outlook? That's probably one for you, Pete.
Yeah, no, so we absolutely have utilised the the government support that's been available. So we've had approximately 10% of our staff furloughed through the last quarter. And that's been typically production staff where we've aligned the workforce with the demand. So we have utilised that support that's available. We have increased that slightly in the last few weeks to enable us the flexibility of the revised scheme for the next quarter through to the end of October. In terms of cash conservation, we did utilise the deferral of VAT and the like. However, by the end of Q1 this month, we've actually caught that back up. So in terms of the question around, is that in the plan and in the existing cash balance, there was a relatively small level of favourable cash impact from government support at the end of March. It grew through April and May, and it's unwound by June. The bigger impact for the favourable cash position was actually the terms with suppliers, which you can see in the cash flow with the trade creditor working capital inflow.
Great. Okay. I think we've got two more questions that we can probably fit in. The first one is from Sam M. Who do you see as your main competitors?
We don't really have, this to be arrogant, we don't really have a single competitor. We've got a mixture of competitors in various parts of our business. I suppose the nearest list is the Discover IE, carrying the same sort of model as manufacturing and distribution, but they really work in different areas to us. Most of our competition we find are some big global distributors on the bad side, but more typically smaller private businesses to an extent across the business. So there's, as I say, generally not one company we come across all the time.
Super. Okay, thank you, Gary. Now, look, there's one last question, which might be a good one to finish on. How close are you to achieving your 5-year plan? What is the target that you are aiming to hit? Now, it might be that you just put that in context by explaining what the 5-year plan is, and then that would be probably a good place to finish.
The 5-year plan is to, by 2022, to double the size of the business, and the key measure there will be adjusted EPS. So we started at 30 pence broadly, and the target is to get us to 60 pence of adjusted EPS. And as I say, we've grown at 50% since 2018. We're actually 54% of the way there, to be precise, at 46.3p as of the end of March last year. So we're absolutely on track for hitting that goal, and we've got plenty of good opportunities to explore it in the coming couple of years.
Excellent. Okay. Well, look, thank you both for updating everyone today as part of your roadshow. Greatly appreciated. If I could ask investors not to close the session, as you will be automatically redirected for feedback. So if you access this meeting from the website, then the feedback page will appear. If you access via the link, then an email will be sent to you to log in to submit your feedback. If anyone has any further questions or would like further information on Solid State, then please do get in contact via solidstate@walbrookpr.com. Alternatively, thank you again, and we will bring the presentation to a close.